Good morning and welcome to the Third Way Investment Partners Leadership Dialogue on Emerging Markets. This time we have done it in partnership with All Weather Capital, a leader in responsible investing. We also have done it in partnership with Third Way Avant, a partnership whose details I will disclose later this morning or afternoon. It is indeed a good morning from our colleagues in the US. Dimasiari, good afternoon from our colleagues here in Johannesburg as well as Cape Town. And it is a good evening from our colleagues who are our guest speakers, Martin and Leslie, who are both based, well, this evening they are in Beijing. It is indeed a dialogue, and so we like to keep it as interactive as possible. And so please use the chat function for any questions that you may have during the session. We also have a poll. We think it's important as institutional investors on the call, both institutional investors as well as asset allocators who have views on global asset allocation and in particular emerging markets. We would like to get your views on where you are from an asset allocation perspective and specifically your views on emerging markets, be it from a diversification point of view or even a return perspective. And so at the bottom of your screen, there is a poll, and we would like you to please submit to answer all the questions on the poll. And we do have a prize for those that are first to complete the poll, as well as those that ask interesting questions. The prize that we do have is a book, and I think our speakers will reflect on it during the session that our chairman, John Oliphant, will lead. It is a book called The Asian Inspiration, Why and How Africa Should Emulate Asia. It is co-authored by 4 people, and one of them has been kind enough to sign it for us. And so that is the prize that we will be giving to the first few to complete the poll, as well as those that are interactive and engaging us during the session with the Q&A. For disclosure purposes, the book was procured at 250 Rand in the event that you would need to disclose it. We hope you find the dialogue interesting and relevant. And as with our previous dialogues, you will remember that we engage on topical conversations. We had our dialogue previously which was chaired by the Territory General of the ANC, Paul Mashatile, when we were engaging on prescribed assets, whether to prescribe assets or whether to allow for policy to make investments available to institutional investors by choice and not to prescribe the assets. More recently, we had the Deputy Finance Minister, Mcebisi Jonas, who addressed us on the post-COVID recovery of the South African economy and how we can use real assets, or even how to grow the economy by investing in the real economy and not necessarily just in one area of your total allocation. With that, we engaged on Regulation 28. We engaged on the potential for private equity to be separated from hedge funds, which we are encouraged that it has happened. We also engaged on infrastructure as an asset class having its own allocation, and we're very encouraged as well that too has been increased. Today, we're not discussing the local economy, nor are we discussing specifically Regulation 28 changes. We are discussing the global portfolio, and we would like to get your views and engage on emerging markets in particular. And so without further ado, I'm going to introduce our chairman, John Oliphant. He is the founding chairman of Third Way Asset Management Group. He is also the co-founder of Third Way Investment Partners, the chairman of All Weather Capital, the chairman of CRISA. With that, John, please go ahead and introduce our esteemed guest, and let's start the dialogue. Thank you.
Thank you, Fulu. And again, I would like to say good afternoon to all the South Africans that have joined us for this dialogue. Good morning to our US partners, and good evening to our esteemed guests, both Leslie and Martin, whom I will introduce as part of my presentation. As you are well aware, South Africa is part of the global economy. I don't know if my slides are moving. But firstly, I wanted to reflect on the size of the global economy relative to the South African economy. As you know, that Africa as a percentage of global GDP only accounts for about 3%, and which means 97% of economic activity happens outside Africa. Within that dimension, we also notice the rise of China as a leading economy amongst the emerging market economies. China today almost accounts for 16% of global GDP, whereas 2007, 2008, China was only 7%. So they've managed to double the size of their GDP post the global financial crisis. So what could be the lessons for us going forward? Those are some of the issues that we will reflect on with our esteemed guests, whom have kindly agreed to share their views with us. Both, this was the slide I was referring to, thank you. China, as you would see, I reflected on this to say that China has somehow managed to double its economy from the global financial crisis to now, and it is estimated that the Chinese economy will be the biggest economy by 2028. That has got implications in terms of investments and how we position our investment strategies going forward. We are also mindful of the fact that we are still within a healthcare crisis, what I usually refer to as the COVIDnomics. That's the new coined word. In terms of the impact of COVID, we know that it has actually slowed economic activity across the globe. The GDP globally contracted by 3.4%. And what is interesting is that it's only China that has managed to deliver positive growth even in 2020 and is accelerating out of the recession much quicker than other economies. So the question is, what are the lessons? And really, that's why we secured two speakers, one of whom is Martin and the other is Leslie. What is interesting, both of them have somehow South African roots. Leslie is a South African export, if I could use that word. He was one of the founding CFOs of the developmental bank, or often is referred to as the BRICS banks or the New Development Bank. We know that South Africa is part of the New Development Bank as in terms of subscribing to capital. And to date, they've got about 50 billion subscribed capital. And then on the other hand, we've got Martin, who's a senior director in Asia Infrastructure Investment Bank, which was established in 2016 with a subscribed capital of about 100 billion. What's interesting is that China, if you look at China's contribution to these new multilateral institutions, has been significant. Clearly, what is starting to emerge is that the world is moving away from what I often call the Bretton Woods Institutes, which were established in 1944, post the World War II. And as you know, that the US played a critical role in the establishment of both the World Bank as well as the IMF. And if you look at the changing dynamics in global economy, you can see that China is playing an active role in establishing new multilateral developmental institutions. And the question that we need to ask ourselves is whether this is the foundation of what I think in 1948 was referred to as the Marshall Plan for the redevelopment of Europe post-World War II. As you would recall, Europe was affected significantly during World War II, and it needed capital to reignite its economy. And the then State Secretary Marshall put a plan where the US injected $15 billion towards the redevelopment of Europe. So the question we need to ask ourselves is that if Africa's GDP only contributes 3% to global GDP, which means 97% of economic activity is happening outside Africa. And the questions we need to ask ourselves is, how do we accelerate our growth and how do we insert ourselves in global dynamics? And these are some of the conversations that I'm going to have with both Leslie as well as Martin. And with those few introductory remarks, gentlemen, I'm not supposed to be doing the speaking here. I'm supposed to be facilitating a conversation to set the scene. Amongst our participants, we've got predominantly South African pension funds, which are currently looking for opportunities to invest. And we're trying to figure out how do we allocate capital in the context of all these economic activities that are happening around us. Leslie, please, the stage is yours.
Thank you very much, John, for the invitation to be with you tonight. Good morning and afternoon to everyone, and good evening for those of you in this time zone. It's a great honor and privilege to share some ideas with you. Let me start out by saying that Martin and I are the only ones probably on this call who live in a truly post-COVID world. You have post-COVID in the way you frame this session. China has zero infections, have had zero infections now for quite some time, and the pandemic is basically under control. So there's life at the end of the tunnel, really. I just want to sort of, especially for those who are, still in the middle of this pandemic, which has ravished not just people's lives, but industries, companies, there's light at the end of this tunnel. The second point to make is that it is very difficult to emulate what China has done, because each country has very unique strengths, very unique features, institutional makeup, culture that are typically ingredients of the strategies that they deploy. And many people ask, how has China done this? Because last year, this time, the pandemic was obviously raging here in China. It's very difficult to replicate what China's done, but that's a discussion for another day. I'd like to start out by saying that multilateral banks, and both Martin and I represent these institutions, are uniquely designed for crises of this nature. As you know, we are global in character. We operate across borders, and problems like pandemics, challenges like pandemics, like climate change, issues like cybersecurity, migration, all of these global challenges that are transnational in character, you need global actors that can, in a coordinated fashion, respond to be responsible for dealing with these crises. So we have been very central in helping many of the emerging markets deal with economic recovery and also deal with the health crisis. Just in short, to give you an example of the New Development Bank, we are owned, as John mentioned, by 5 countries: Brazil, Russia, India, China, and South Africa, the so-called BRICS formation. And early last year, as the pandemic hit the 5 BRICS countries, we put in place a $10 billion COVID emergency response program. And we have literally just a week ago completed the approval of that full $10 billion, $2 billion to each of the 5 countries. We will be announcing another $1 billion loan to South Africa in a matter of the next 2 weeks or so. And these loans were designed firstly to deal with the health crisis, and then secondly, economic recovery. And we are now focused on how best can we utilize our limited resourcing in order to have the highest possible multiplier economic impact in the way that we spend this money. The third point I'd like to make is just to give a 1-minute snapshot of the New Development Bank. As John mentioned, we were started 5 years ago. We today have a loan book of $27.1 billion. And as I just mentioned, in this last year alone, we have done $10 billion of approvals, and also in the next number of weeks, we would have disbursed that $10 billion to help our countries fight COVID-19. These are significant achievements for an institution that did not exist 5 years ago. Another key important point to make, John highlighted the enhanced role that China's playing in the multilateral world today. One of the aspects that I want to also just touch on is the fact that the New Development Bank is an emerging markets bank focused on these countries, but South Africa, Brazil, all the others, we are equal owners in this bank. So the $10 billion that was made reference to of equity or paid in capital, $2 billion came from each of the 5 countries. South Africa is maybe, I think, 34 times or so, or China is 34 times the size of South Africa in GDP terms, but South Africa has equal say in the running of this institution. We have same number of one person on the investment committee, one person on the credit investment committee, one person on the board, one minister of finance representing us. So South Africa is really playing in the big league as a member of this institution. I'd like to now just give a snapshot of some of the top of mind issues when I look at emerging markets today through the development finance lens. Now, the topic of today is emerging market opportunity, but I'm going to focus specifically on infrastructure because that is what we are tasked with as multilateral banks. I'd like to start off by saying that there remains a massive, a very large infrastructure finance gap in the world today, and it is most pronounced in emerging markets. This infrastructure gap also exists in the developed world where infrastructure is aging and there needs to be a replenishment of infrastructure, whether it's in the United States, large parts of Europe and so on. But today we're talking specifically about emerging markets. Infrastructure represents a very attractive investment opportunity. And to date, it has been, there's been a very slow movement into infrastructure as an asset class because the risks associated with infrastructure is something that large institutional investors have not been comfortable with. In other words, both the perceived as well as the real risks associated with investing, in big infrastructure projects, whether they be ports, whether they be rail projects, the building of airports, power stations, and so on. All of these projects have risks which have made the likes of pension funds, insurance companies, sovereign wealth funds reluctant to enter. So we are really seized as multilateral banks looking at ways, how can we best play a role to attract more infrastructure, more institutional investor capital into infrastructure. And there are a few trends that I just want to sort of highlight, or strategies that we will be deploying to ensure that there's greater crowding in of private capital into infrastructure over time. The first point to make is that there's been significant efforts to standardize infrastructure as an asset class, right? So you have in the various sectors, and you've got multiple approaches, multiple frameworks, metrics, impact assessment. The industry, there's almost a cottage industry of measures and environmental standards that each of the banks have put in place. Over the last while, and this is now being firmed up, over the last while, there's been efforts to synthesize and to standardize and harmonize all these so that it becomes more, we can create a more enabling environment to bring in institutional investors into the sector. So that work is unfolding, and we can talk a little bit more about that if there are questions around it, but there are a number of initiatives underway to do that. The second major trend that I want to touch on is the move towards sustainability and the focus on climate finance. Over the last decade and a half, but specifically after 2015, after the Paris Agreement, there's been a steady snowball sort of shift towards more resources going into sustainable infrastructure. And both AIIB and New Development Bank, we are committed to sustainable infrastructure, which means that most of our funding goes towards, for example, if it's in the energy sector, 100% of our energy investments are in either offshore wind, or it's in solar, or it's in hydro, but we are not doing investments into coal. So this movement to sustainability is going to be a defining feature of every single asset allocation decision that is made in every boardroom over the next number of years to come. As you know, about 60% now of the G20, 12 countries in total, have committed themselves to 2050 carbon neutrality. What that means is that in every country, there will now be targets that will be set. And in China, already the process has begun to put in place 2035 targets that will be announced, which is the midway journey towards 2050. And essentially, these targets are about how industries, companies, business models will change in order to give effect to this carbon neutrality. And just for those of you who are not maybe familiar with this jargon, essentially carbon neutrality is about making sure that we only emit as much carbon as what we take out of the atmosphere. And countries have started to put 2050 as the target to reach that objective. What this move towards sustainability will do And this, by the way, is codified in a number of statements of some of your big asset managers. Most recently, as you know, Larry Fink, in his letter to CEOs, the CEO of BlackRock, one of the largest asset managers in the world, indicated in the letter that climate risk is investment risk. And what this effectively means is that you will no longer have sort of, separate portfolios that are focused on targeted around sustainability, but entire portfolios will be moved into the sustainability buckets. What this means is that companies that own brown assets, if you sit with a significant portfolio of coal and other brown assets that reach the end of their lifespan in 15 or 20 years, those will become stranded assets if you do not have buyers who will pick up those assets from you when you want to exit, which means that companies will be revalued, which in turn means that's going to be reflected in pricing. So in short, sustainability is going to be a major theme going forward. And I believe that post COP26, which is taking place at the end of this year in Glasgow, COP26 is the gathering where all the governments throughout the world and industry get together to look at progress that have been made with regards to the climate targets. And it is very likely that there's going to be a larger number of countries that will adopt these carbon neutral by 2050 objectives, which means that industry will shift their business models towards achieving that objective. The final point that I'd like to make is that there's also a couple of changes that are happening in the tools and the instruments that we deploy as banks. And I'd love to see whether there are questions in this particular arena, meaning what can we do as institutions to enable and to facilitate? What kind of de-risking of in the infrastructure space, what kind of instruments can we deploy, such as guarantees, for example, such as first loss instruments, where we can create more of an enabling environment for large institutions to invest alongside us. And there's a lot of instruments that have already seen the light of day. Blended finance, for example, is one that is increasingly being utilized, where you blend in concessional funding together with commercial funding in order to improve the risk return profile. So in short, John, there's a lot of interesting developments in the infrastructure space. We would like to be the enablers and to be the catalysts to crowd in more funding from your large institutional investors. And it would be useful to see whether there are any, what the obstacles and hurdles are that some of your clients, for example, view, which we should be focused on. So I'll pause there and then open for questions later. Thank you.
Thank you, Leslie. I purposefully sat and listened carefully. I think you've touched a number of key points. I've also seen on the chat room that there's a number of questions that have come through, both from Sipho Sudu, Eric Fisa, and others, and that I will bring them to your attention later on in our conversation, including my own questions around what role can institutional investors play in making sure that we are able to use the muscle of this $150 billion US to co-invest alongside institutional investors. With those few words, Leslie, thank you very much. I think it has been very insightful, and I would now like to give Martin an opportunity to also make his opening remarks, and then we can have a conversation. Martin, you are still on mute.
I just unmuted. Okay. Thank you so much. Also, thank you so much, John Fulu. It's a real pleasure, to speak on this webinar. And as you said earlier, I also have a very dear connection to South Africa. I lived in Johannesburg. I was a 3-block neighbor, Mr. Mandela, and I have very, very special memories to my time in Africa, and look forward to the pandemic to subside, able to have a chance to go back. So I am tasked to bridge, where is my presentation here? Here goes, to bridge the broader infrastructure theme to actual investing and also link it to equity. So I called this presentation Infrastructure and Beyond. As Leslie, we represent a longer-term phase shift of China that shifted from looking inwards to looking outwards. So we both represent institutions that do look outward. And I obviously want to paint the picture beyond the pandemic, because the very long-term trends are still intact, and I want to draw from some lessons in China, what they could mean for Africa, what they could not mean for Africa, and what lessons we can apply for future investing themes. So basically, if you look at how much China has been investing in infrastructure, whether other countries have been investing in infrastructure, obviously China is the standout, with essentially average number for a longer period of over 18%. At years it was 25%, even at once it peaked at 30%. So that's such an exceptional number that China has been investing in infrastructure. When we look around other economies, the developed economies we normally see 4 to 5%. The high savers we see higher numbers, and the low savers on developing economies, the ones who are doing better, at least have done 8%. Now there is a risk of investing in infrastructure. You can overinvest. If you build a bridge that nobody crosses, you've overinvested. But why was China so? Yes, there are empty cities when you take the train from China to from Beijing to Shanghai. Those cities do exist, but overall, China has done a magnificent job in planning and implementing an infrastructure investment plan that really created the environment for a very high growth rate. But if you invest in infrastructure, you have to have an enormous planning and implementation capacity. If you build an airport, you will build the airport to reach the break even in 10 years. That means for 10 years you have negative cash flows. So you have to have an operating environment where you can support that airport for 10 years with negative cash flows. In many countries, that airport would not function anymore in 10 years. We look at Africa, the number we have seen on average 3%. So obviously a vast underspending in infrastructure, and which goes in line. I mean, there are essentially only 2 countries that have significant manufacturing capabilities, and that has to do with the availability of base infrastructure. The other thing that is currently true in Asia, they talk about the infrastructure gap of 14 trillion over about 10 years. It's today cannot be financed also in Asia, because still it's largely financed by public hands. 90% in Asia is financed by public hands. While you see this 2%, these are all the development banks together, where only 8% is financed by the private sector. So the challenge in Asia is to bring in the private sector, because total public sector cannot do more than 20% of that 14 trillion. So the challenge is to bring in the private sector, but at the same time, Asia is the savings pool of the world. So obviously the pool is there. It really is that the problem to intermediate from the savings pool into investable projects. That it has not been done yet as successfully, it is difficult. If we look at Africa, that problem is even more pronounced. Obviously, at large, the only financing source for infrastructure at large has been the public sector, with much more limited access to financial resources. And at the same time, there is private sector money that is looking for a home. McKinsey estimates it's about $500 billion. That is a sizable amount for Africa. But what is short is the shortage of investable and bankable projects. And that links to obviously much broader issues, regulation, sector reform, deregulation, governance that are very often not in place to sort of accelerate and attract infrastructure in investments. Now, when we look at the big mega trends, if you invest, you want to look at the mega trends in order to be right. So even if you have a little bit of headwind, if you know you are following some of those mega trends, you can bear some volatility. And they are essentially very similar, whether you look at Asia or whether you look at Africa. In Asia, look, within 2015 and 2030, the middle class is essentially doubling. Now, that is not as pronounced in Africa, as the average population is a lot younger. But you were going to see the same trend, not in every country at the same time, but your affluent population is steadily increasing. Then you look at urbanization. That's the Asia picture, with the red dots, the mega cities. And you can see the number of mega cities is increasing by 2030. And on top of it, we have continued urbanization. So in Asia, another 550 million are expected to move to cities. So not only have to we retool the cities for the changing needs and demands for its population, but we also have to make space for another 550 million. The other subject Leslie has talked about more and more, obviously, climate sustainability goals are important, and I just have shown there, even from an investment thesis perspective, way more important in the developing world than in the developed world. 2/3 one would expect to go to the developed world. Also, despite recent disintermediation of supply chains, we continue to believe, or I continue to believe, that the regionalization of trade will continue, particularly if you look at the picture, sort of the difference between longer term 2090 and 2020. If you look at Africa and Asia, certainly those trade linkages will continue. Last not least, disruptive technologies have become a robust trend signal for us, having to reconsider how the future is going to be different from the past. And I just want to mention a few. We all know how the mobile internet is changing. We know what it meant in Kenya for financial intermediation. We learn about the cloud technology. We learn about storage of energy. Also, as an example, on the renewable space, we have seen a decentralization in generation. So today, infrastructure investments are not anymore this very large scale investments. There has been sort of a much smaller scale technology, both in terms of solar and wind, allowing smaller sized investments and therefore accessing a much broader investor base. We have also seen on the technology side, on the distribution side, seeing changes that allows smaller scale private sector investment to essentially offer a much better service. Water, the same. We have seen that even in the poorest of all communities, people are willing to pay for better water. And that's where technology opened up new sectors in the traditional infrastructure space that was dominated by large-scale investments. Just to sum up sort of the near-term changes in where they're most relevant, obviously mobile internet, 5G, then the automation, big sector, Internet Things of Things, the connectivity between different parts in the value-added chain. Cloud technology is also very important, particularly in Africa, as the internet connectivity starts to rise very fast, and at the same time you become independent from local server networks and are therefore able to leap beyond sort of local server technologies. What does it mean to go beyond traditional infrastructure? And let's just look at some examples from sort of the driving forces that I mentioned. Sustainability, look both on the supply and on the demand side. Investors are willing to pay a premium for infrastructure investments. Consumers are willing to pay a premium for sustainable products. So that is going to change the field, as Leslie has spoken about. And this is today the fastest asset class. Technology, I spoke about it clear, the telecommunication, also Africa is not going to be unaffected by AI. Internet of Things, cloud and data centers. I spoke about the value chain, the attractiveness of supply chains, particularly linked to Asia as an attractive investment target. Urbanization with smart cities, with different transport configurations, with different demand in health services, digitalization is offering also in Africa a significant opportunity where Africa can learn from Asia. And ultimately, the classic demographic changes, increase in the affluent middle class, shifts preferences, more demand for healthcare, more demand for education, more demand for mobility, which should be a strong investment themes going forward. And this has already happened. The world has moved beyond the old physical to soft infrastructure. Today, financial services is a key element of infrastructure for an economy to function, with that effect to be a multiplier for the rest of economic growth. And obviously, health and education with income per capita, that is a steadily increasing sector. You see the average age is increasing. Populations are aging. With aging populations, healthcare needs are increasing. So that's a very safe and steady field of above average growth. And then obviously I spoke about the disruptions in the telecommunication and the digitalization side. The big question here is, what shall we do in EM as a class? One law is always true. Diversification is the only free asset that's out there. Now, should you be invaded in overweight in EM in an unselective way, do we have a super cycle ahead of us, like we had in the early 2000s? You heard yesterday from the Fed, they're not going to raise rates essentially until 2024. You heard that the official forecast in the US is 6.5%. World Economic Outlook increased the forecast of world growth. So we see actually the world becoming more optimistic on the recovery out of the pandemic. Question is, if we look at if other commodities are a longer trend signal, there is a chance for a super cycle. What was the super cycle? It essentially was three factors that came together. You had fiscal monetary stabilization with many emerging market economies. You had much stronger growth together with a healthy commodity cycle, and you also had exchange rates going the same way, meaning in general a stronger exchange rate performance of many emerging market countries. That's why a super cycle. This was the period where EM essentially outperformed. If you look at the longer time horizon, EM as an asset class did not outperform. So the question is, with sort of the outlook, with the trends signals in the commodity cycle, and many emerging market economies being still better fiscally, in better shape than many developed economies, do we have a chance for such a super cycle? If we don't have a chance for a super cycle, depending on your assessment and on your appetite, obviously we should look to EM in a differentiated way. One has to recognize their fundamental differences, particularly the structural factors. I would say where Asia and Africa is in better shape than the other regions. And so you would therefore think that the growth outlook coming out of the crisis in these two regions offer you better opportunities than in the other two regions. And last not least, you obviously have to think about, there's always the public market, there's a private market. Not only does the public market, I think with the exception of China and India, is more geared to traditional industries, and the private market is more forward-looking. So depending what type of sector exposure you want, the private market obviously gives you a much larger universe to structure a portfolio and be exposed to future trends, particularly in the disruptions. With the two biggest markets, the only observation there is to share that in India, the public market has been significantly outperforming the public market in China over the last 20 years. On the private equity space, it's the reverse. And that has to do with the overall finance and governance conditions in the countries, where in China, obviously, all the financials are very much geared to bank finance. So not so much shareholder revenues. That's why in the private market, we were able to regulate this governance structure. You were able to do very, very well. And in India, it was the reverse. You had a very strong, well-governed public market, but on the private market, returns in general stayed behind. With that, I want to pass it on and back to John. Thank you so much.
Thank you, Martin. I must say that what I liked from your presentation, you made it very clear that diversification is the only free asset, which is quite exciting. I think the only enemy for us at the moment is time. So I think I'm going to ask you and Leslie a few questions and try and bring in the questions from the audience, and hopefully both of you, if it's possible, you could be brief in your response. What I liked in terms of your questions at the end, Martin, I think that links quite nicely into our session on how pension funds can access EM opportunities. So I think those type of questions would also be answered in our next session on the webinar. I think going back both on your presentations, is that, Leslie, on your side, I really appreciate the fact that we as South Africa, we are really punching above our weight. I wanted to bring to your attention that South Africa has been one of the leading countries in responsible investing. In fact, the Government Employees Pension Fund of South Africa was the founding signatory to the UN-backed Principles of Responsible Investing, which was launched in 2006 by the late Kofi Annan, and it was spearheaded by a close friend of mine called Paul Clement Hunt, who has actually put in a question for you, Leslie. And a question from Paul is that, how can DFIs go beyond big infrastructure, big projects, and start focusing on other stuff needed in terms of, creating more access, creating more jobs, and so on. My understanding, and before you answer, Leslie, I think partly this question was answered in Martin's presentation when he talks about a move from hard infrastructure towards soft infrastructure. But really, I would like to give you an opportunity to reflect, maybe sharing your experiences in terms of the new development bank, in terms of what other investments do you consider in terms of helping economies to grow going forward?
Thanks very much, John, and thanks, Paul, for the question. Multilateral development banks typically have very large ticket sizes that we concentrate on. And we are very focused on ensuring that we do not in any way displace or crowd out or distort the local market. By that we mean, as you know, multilateral banks have one unique feature, and that's our very high credit rating. AIIB is a AAA institution, New Development Bank is AA+, just one notch below, which means that our cost of funding would be the lowest in the market. it would therefore be very easy for us coming in with cheaper funding to distort or to crowd out your financial services industry, your other commercial banks and financial players and other players in the infrastructure investment space. So for example, the lowest transaction, the smallest transaction we've done is $100 million. Average deal size in on our book right now. We've got 71 projects, 27.1 billion. You divide the one by the other, and you will see it's about $250, $300 million on average our loans. But that does not mean that we only do mega infrastructure. One of the questions also that have been posed here is it makes reference to the last mile. What we want to do is make sure that we can play the role as an enabler. Sometimes what is required is to improve the investment climate, is to improve the regulatory environment, is to remove regulatory or legal obstacles, to enable smaller SMMEs, for example, to also play, let's say in the telecoms market, for example. So we do look at that value chain, but we do come in as the principal provider of bulk infrastructure, building of ports and railways, power, and so on. But your point is absolutely spot on.
Yeah. No, thank you, Leslie. Martin, you know, you made a good example on over-investments in infrastructure. In my previous life, I actually oversaw an investment into an airport in Tunisia. And what was interesting about that investment is that obviously you'll rely a lot on advisors who would, you know, write reports around political risk and write reports around economic activity and so on. And the experience with that asset is that obviously the report said there's a low political risk, but what transpired, it was as you know, what happened in north parts of Africa, both in Libya and Tunisia and so on. Obviously that asset has not really performed in line with the assumptions. So those are some of the experiences. I think here in South Africa, our overinvestment in terms of infrastructure was actually building World Cup stadiums that we built for the 2010 World Cup, and they are currently underutilized. I so wish we could have used that money to invest in some of the current challenges that we face, including load shedding, as we experiencing so seriously in our country. But of course, we need to be positive. And your message was very positive to say that Africa, as well as Asia, are likely to come out better out of COVID-19. And in effect, you guys are so blessed to say that in Asia, there's very limited number of cases. I was recently a victim of COVID, and I'm glad that I managed to make it, and hopefully I still have antibodies until the vaccine comes into Africa. But there is a question here. When we talk about the relationship about Asia and the relationship with Africa, Sipho Sidu, the principal officer of SALA, has asked a question. He says that, how does Africa protect itself from the conditions that come with China's investments, which in some instances are not in Africa's interest? I don't know if it's a loaded political question, but maybe you can give examples in terms of the actual investments that your institutions have made on the continent, and what are your views on the conditions that have been put forward.
Thank you so much. And look, I was actually in an Africa Cup final in the Johannesburg Soccer Stadium, so I at least I was able to use it. But it is a pity, and I'm a big soccer fan. So there are two things. I'm obviously not speaking on behalf of China. I was responsible for Africa 2012, 2014 on the risk side of Africa, and I certainly did see first round investments that might not have met, I would say, international standards. Both the NDB and the AIIB, we do invest along best practice principles, and those are very clearly international standards, procurement rules, environmental social standards that are essentially in line with World Bank. So this is precisely our objective wherever we participate, we're going to make sure we apply the best standards. We want for a counterpart that takes on foreign currency debt to get the best product, the best way delivered, and at the best price. So from our end, this is very, very, very important. And we were often thrown into the basket of BRI banks, which we are not. There are some investments that we do that would qualify as BRI, but as I said, it happens coincidentally. But even officially, sort of with respect to BRI, you might remember that President Xi sort of also made a very strong commitment to move towards international standards, ESG, environmental and social protection rules, transparency of bidding and procurement, etc. So to me, those transparency rules are very, very important. And if you are the local counterpart, then that is I mean, that is the best practice, and it protects in the long run, even if it's a bit more complicated. Clients do complain, yes, it takes longer, you know, but it ultimately is there for the protection of all parties. And as I said, it goes along with long-term foreign currency liability. So therefore, countries need to build.
Yeah. No, thanks, Martin. You sounded like a politician. You know, usually politicians would say, "I don't answer, you know, on behalf of my president," but I think he would say 1, 2, 3. So I think you have been well trained there. I think we almost running out of time, and I would want to maybe give both of you maybe parting shots, but to frame those quickly. I mean, from a South African point of view, as a South African investor, when you look at pension funds here, 60% of their assets are invested in companies listed on the Johannesburg Stock Exchange. And the challenge we have is that we're talking about future mega trends, where you're talking about artificial intelligence, you're talking about the developments in healthcare, development in terms of 5G technology and so on. And unfortunately, in South Africa, I haven't seen really a lot of leading domestic companies that are driving these trends in the context of Africa. But what I've seen is companies that are listed on the JSE, but the money is invested in China. Okay, for example, Naspers. So the question is then, how can Africa be able to adopt those technologies and bring them into the continent, mobilize the continent going forward? So one of the questions from Shane Watkins is to what extent that the very high weighting of China, even in South African JSE, the highest weighting on our index is Naspers, and Naspers derive most of its revenue or growth in China. So there's a misallocation of capital. If you would like to make a comment in your closing remarks, I'll each give you an opportunity to make a closing remark as a parting shot, but maybe also reflecting on how we can position or at least find a way to bring technologies here so that we are not left behind in terms of what's happening elsewhere. Parting shot, Leslie, parting shot.
Thank you very much. Very briefly, China, as Martin or you mentioned earlier on, is destined to become the largest economy in GDP terms in the next decade or so. That is an inevitable, unstoppable momentum towards that. For that reason, because of the sheer size of this economy, $13.6 trillion, larger than all of the BRICS countries combined, the other 4 countries within our bloc, for example, it is natural that there will be this misalignment. Just take a few of the companies here: Ant Financial Services, Tencent, Alibaba, and so on. These companies in market cap, each one would be in the trillions of rands. Ant Financial, a subsidiary of Alibaba, is $150 billion company. So that size issue, Africa, you correctly pointed out, John, represents 3% of global GDP. We are still, on a significant growth trajectory, and that brings me to my point I made earlier on about infrastructure. There's a massive big infrastructure gap in Africa. Infrastructure is an attractive asset class. Infrastructure presents there's low volatility in the asset class, predictable cash flows, attractive returns in many of the different components, as heterogeneous as the sector is, whether it be power, ports, data centers, everything represents very attractive potential investment opportunities. Now is the time. There's no way that Africa can double in its contribution to global economy unless we have power. For example, we still have 35% of people have access to continuous uninterrupted supply of power on the continent. So we have to go back to the core basic. Yeah, so just a parting shot is the infrastructure as an asset class. I'm making the pun that there needs to be greater focus on the potential in the various subsectors of infrastructure. Thanks very much. It has been a great privilege to be part of this conversation. Thank you.
Thank you, Leslie. And I would like to say to our audience, I didn't write your script about infrastructure. I do love infrastructure. Martin?
Thank you so much, John. Yeah, the parting shot. Look, yes, there's Naspers. Largest holding of Naspers is in Tencent. But don't forget, Naspers also holds TV rights and telecommunication rights in parts of Africa. So there is interesting, super exciting things happening in the tech space in Africa. You look at West Africa, you have to look harder. Then you're not going to have these mega companies. But this doesn't mean there are no opportunities. I see more and more a culture of African entrepreneurs. But as said, you have to look harder. And the other thing where I'm way more optimistic, I think South Africa has an incredible quality of asset managers that have been, developing the business since the last, including you and everyone else. No, but that is absolutely true. It's the top class professionals, all well trained. When you look at analysis, whether it's listed managers or private equity managers, when you look at the quality that is provided, it's outstanding. So I am sure that South African managers will hold their ground also outside South Africa. And this is a play for smaller, medium-sized companies. Look harder, but there are companies outside Tencent.
Yeah.
Thank you again. It was a real privilege, and would have loved to be there in person.
Yeah. Thank you very much, Martin. Thank you very much, Leslie. I understand that both of you are going out for lunch. I wish, no, not lunch, dinner actually. I wish I could join you, but I promise immediately when I'm allowed to fly out of South Africa, the first journey I would make is to come through to Shanghai and Beijing, and hopefully we can have an in-person conversation. I really appreciated your input. I can see that there's a lot of questions from our audience, and most of those questions are actually going to be answered by the next panel in terms of how do you access these opportunities in emerging markets, both from a listed perspective as well as from an unlisted perspective. And with that, and also I would like to remind our audience before I hand over to Fulu that there is a questions survey that you need to respond to. I hope those have had opportunity to respond to. And also the book, as fully indicated, we've got a book that's available. And I think most of you that have been asking questions, I can see Shane has already procured a book for himself. Paul Clement Hunt has procured a book. Sipho Sidhu has procured a book. And I saw other questions from Hubert Denso and others, which are probably likely to be answered by the next session. From my side, as the chairman of the dialogue leadership, it's time for me to hand over back to the Vice President, Ms. Fulu Makwetla.
Great, thank you so much, John, and thank you so much to Martin Kimmig, the Chief Risk Officer of the Asian Infrastructure Investment Bank, as well as the Vice President and and CFO of the New Development Bank, Leslie Maasdorp. And thank you, John, for all those engaging questions and dialogue. Martin, I'm going to ask you to stay, but you will not be part of the panel, but should there be further questions, and if we do have time to engage further, we would like to do so. I would like to, at this stage, just remind everybody, as John has done so on the polling, the responses have been very far and few in between. So if you could please just help us get an understanding of your view on global asset allocation, emerging markets in particular, both before the views of Martin as well as Leslie, and then following the session that we've had, and also what your views will be following our engagement with Neil Smith and Heidi. So without further ado, I'm going to introduce the next session, which is basically how do we find investment opportunities? Or what are the investment opportunities and how can they be accessed? Is it through listed markets? Is it through private markets? What are those in terms of a diversification? What are the mega trends? How do we access? We know that, you know, some of the larger, let's say tech investments, for example, your Facebooks, your Uber and the likes, were mostly unlisted long before they came to listed markets. And so do you derive value in investing in private markets long before you go to listed markets? And, you know, in the 1980s, I think emerging markets were referred to almost as a new term. And now the debate is Asia still part of the emerging market? And I think at the time, the IFC was probably one of the largest investors in emerging markets. And when I do introduce Heidi, who has been with the IFC, who was with the IFC for many, many years, investing in emerging markets, I'll refer to some of the work that she's done there, and obviously the development of emerging markets and private markets in particular. Without further ado, I'll introduce Neil Smith. Neil is the portfolio manager of the All Weather Capital Emerging Markets Fund. He has over 20 years experience, and throughout his career, he's always been focused on emerging markets. He's worked at some of the largest international investment firms and has spent several years working overseas. He joined All Weather Capital in 2019 and has been managing the All Weather EM portfolio since then. Over to you, Neil.
Thank you, Fulu, and yeah, thanks for the opportunity to present in front of the audience, and welcome everyone. I'm just going to share my screen quickly. Okay, I'm hoping you can all see those. Can you see those slides? Is that
yes, we can see the slide.
Okay, good. Okay, good. Okay. All right. So I'm going to start off quickly with a quick macro settings to give the backdrop where we are. So the slide here, what we've got is on the top part of the slide, we've got the MSCI Emerging Market Index relative to the S&P 500 going back to sort of 2004. And what you can see, if you look at that red arrow going down, is that emerging markets have underperformed the S&P materially over the last decade. And on the far right here, it looks like we got a little inversion here. We're starting to inflection point. Emerging markets recently have started to outperform. Directly below, we've got the DXY, the trade weighted dollar, and you can see how the dollar strength has coincided with a period of emerging market underperformance. And more recently, again, we're seeing the sort of dollar rolling over, although it has stabilized current levels. And you know, this is the question. So you know, Martin touched on: are we on the verge of sort of emerging market super cycle, or the jury's out? But I think if you take a step back and think about things, I think the probability are that the answer could be yes. If you consider, you know, the situation in the US, the global positioning, everyone is extremely overweight all US assets. You know, for example, the US accounts for 24 to 25% of global GDP. Its weighting in the MSCI World Index, all country world index, is 58, and that doesn't take account of the weighting in treasury assets and so on. So, you know, you also look at the fiscal situation in the US and the amount of dollars that have been printed. I think the case for a weak dollar going forward is quite strong, and that is a key, one of the key asset allocation decisions when, you know, for the support in emerging markets. What we've got here for our South African audience is we've got the MSCI South Africa relative to MSCI emerging markets, and we can see how South Africa has underperformed MSCI Emerging Market Index. And the point here is that so from a global investor audience perspective, we really need to see a change in sort of and delivery of a reform agenda to attract capital. This chart sets it out quite nicely. And if you look at the black line, this is South Africa's index weight in the MSCI Emerging Market Index. So back in 2004, South Africa was just over 10% of the MSCI EM. Today, it's below 4%. Now, that is a problem because from a global active manager perspective, South Africa is now small enough where active funds can take the risk of, from the tracking error perspective, of not having any exposure to South Africa. So while we, as emerging markets get inflows, South Africa has that tailwind benefit from passive inflows. Active managers need to see unique investment opportunities to attract them here, and linked to that from a macro perspective, as I said, was we need to see delivery now of a reform agenda. This is a slide just to give some perspective. So what I've got here with the South African flag on is the JSE, and I've stripped out NASPERS and process, and I put it into dollars. So at the end of February, JSE ex NASPERS and process was about $430 billion. And this contrasts to the size of one company in the MSCI EM index, AIIB, which is sort of multiple sizes of our market. It ties into the comment John was saying about the size of the South African GDP. This is for reference, everyone. Just this is the composition of the MSCI Emerging Market Index by country going down and by sector going across. So you can see some of the big sectors here. IT is the largest, and that's really the exposure to semiconductors, which is a key industry for growth going forward. You can see the second largest there is really consumer discretionary. So you've got your companies like AIIB in that space, consumer service, communication services, Tencent sits in there, and then financials is another big one. By country going down, you can see China is roughly 39%. You can see South Korea and Taiwan. Asia combined is close to 80% of the benchmark and the opportunity set. But that's for reference. So a quick few slides on why emerging markets, try and build the case from the bottom up. Why? Well, there's a few points. I mean, firstly, I'm going to show you emerging markets materially outperform developed markets over time. All the growth pillars that drive that growth are intact. Valuations are attractive, and from a portfolio perspective, they are great diversifiers. I'm going to show you those all now. So if you look at, I'm trying to get my slide to change here. Let's go back. Sorry, guys. Okay, that's the slide I want. So what we've got here, going back to 1970, if you focus on the orange line, that is the MSCI emerging markets relative to the MSCI world. So emerging markets relative to developed markets in dollars, total return. And what you can tell is that emerging markets do materially outperform developed markets through time. If you focus on the bubbles, that shows you on average since 1970, you've got an 11.1% annual return in dollars in emerging markets versus 6.6% for developed markets. So it's roughly about a 4.5% difference. And if you compound that per year, a long period of time, that's a significant number. But what you will also notice, this doesn't come in a straight line, right? You can see that there are clear market cycles, clear bull and bear market cycles, and they're quite long duration cycles. So if you can get your timing right from an allocation timing perspective, you can materially increase your returns. The blue line here is actually quite interesting. That is the differential in terms of GDP growth between developed markets and emerging markets. And often, well, usually historically, as soon as that gap starts to widen, so the growth in emerging market accelerates relative to developed markets, that usually coincides with a period of emerging market outperformance. And I think that is exactly where we are. Martin was also, and Leslie were also talking about China and how well, and John also referenced it, how well China did, but that's true for most of Asia. Asia is really well positioned to grow from here. This is a key thing to bear in mind, and this is the demographics. So what we've got here on the left-hand side, the population pyramid in orange, that is for the entire population living in the developed world, and on the right-hand side in blue, that's for the emerging markets. Now, if you just focus on that orange one, the developed regions, you'll immediately see that that is, the percentage of young to old is small. That's reflective of a aging population. That is generally bad for growth. Why? Well, as your percentage of retired elder people in the population grows versus your working population, I mean that puts incremental pressure on your economy. So you think of countries in Europe, such as the UK, for example, they've got unfunded pension liabilities and healthcare systems. So there's no asset base. Those are entirely funded of tax. So as your percentage of retired people not contributing and acting as a drain, that is only funded through increased taxes on your working population, which is less disposable income, bad for growth. Now, if you contrast that to the other side, emerging markets, it's almost exactly the opposite. You have young, growing populations. That doesn't necessarily entitle them to good growth. What you need is a combination of good economic policy to attract capital. You need focus on healthcare, infrastructure, and education. And in those countries where they get that right, you are seeing what people refer to as a demographic dividend, which is really a growing working population adding to real GDP growth. Urbanization is another key trend. So just to explain this chart quickly, on the vertical, we've got a measure of wealth. That's your GDP per capita in dollars, just noticed on a log scale. And on the horizontal, you've got your urban population percentage. Now, if you look at these different countries, you'll see the trend is the same. As through time, as your population urbanizes, they become wealthier. And that's obviously a very powerful economic force, particularly for consumption. Now, why is that is a quick question. And I can explain that quickly through a couple of examples. It's really economies of scale. Imagine you're a local government developing, rolling out basic services such as water, electricity. It's much cheaper to do so on a per capita basis if you are in densely populated regions versus rolling out in the countryside. Another one is if you're a business operator, say you own a food retail store in a city, you've got a huge advantage through increased foot traffic coming through your stores, leads to higher levels of sale and profitability, particularly compared to your competitors in the countryside. So those economies of scale, just lead to greater profitability, to attract talent, to drive growth, which becomes this virtuous circle in cities. Valuation, very quickly, this is the 12-month forward price to book, emerging market relative to developed markets. And you can see trading close to -1 standard deviation. So despite the recent outperformance of emerging markets that we've seen in the last few months, still a very, very attractive level. I've recreated the efficient frontier here. So this is from a diversification perspective. So what we've got here on the vertical is your annual return in dollars. On the horizontal, it's your annual standard deviation of return, your measure of risk. If you focus very quickly on that black circle, DM100, that's a portfolio that consists entirely of developed market equities. And it's, as you'd imagine, low return, low risk. But as you start allocating capital to emerging markets in that portfolio, not only do you increase your return, but you also bring down your risk. And actually, for the same level of risk as that DM 100% portfolio, you can enhance your return by roughly 3% a year in dollars by having a sort of close to a 50-50 allocation. And so this is 50 years of data. So this is the same chart, but this is South Africa versus emerging markets, and I think this is very interesting, and it's a very compelling reason why South African pension funds need to have exposure to emerging markets. If we focus on the far right, that's a portfolio that consists entirely of South African equities, and it's fairly low return, quite high risk. And as you start allocating capital to emerging markets, not only do you bring your risk down, but you push your return, expected return up. So, I think that's, for all the reasons I've spelled out in terms of the fundamental bottom-up situation from the drivers, the outlook for emerging markets is very good. And I think this is very compelling. That's it from me. I'm going to hand it over back to you, Philip.
Great. Thank you so much, Neil. I think it's quite clear that the investment opportunities, especially in the listed markets, do exist. And there's many reasons which were referred to before by Martin and now yourself around diversification, potential returns, and so forth. And so whilst Heidi is setting up and putting on her screen, I'm just going to introduce her and introduce the partnership between ourselves, Third Way Investment Partners, as well as Advance Capital, to offer our institutional clients, Southern African institutional clients, an ability to access private markets in emerging markets. With that, I'd like to introduce Heidi Selaya, and she is the co-founder and CEO of Advance Capital. She is currently and serves as its Chief Investment Officer as well. She's responsible for portfolio construction, fund selection, product development, as well as investor relations. I did indicate that she's a veteran and has been in emerging markets for many, many years. She was at the IFC for 19 years, and she led the IFC's emerging markets funds during that time. She was a director and IFC's global private equity investments and department, and she also headed up the investment committee of the IFC. With that, Heidi, over to you. Please let us know about the investment opportunities in emerging markets private equity.
Thank you, Fulu. And I might add that I also ran the Sub-Saharan Africa department, lived in Johannesburg for several years. So I also, like Martin, have a very soft heart for Africa. So it's a pleasure to be here. And thank you very much for the opportunity. So I'm the last speaker. I hope we still have people on. I can't really tell. But as we have seen from all of the speakers, the opportunities for investments in emerging markets are quite broad, both in terms of geographies with Asia, Latin America, Africa, as well as sectors. So investing from infrastructure, which I think as a private company investor is critical for the private sector to operate. We need infrastructure with its long-term horizon, but we also want to make sure we invest in niche opportunities such as healthcare and technology. So investing in emerging markets offers this diversification that everybody's talking about, which we believe can enhance returns and lower risk in a portfolio. Now, I will speak during my slides to why emerging markets private equity is an attractive asset class and how it complements an allocation to infrastructure or to listed equities. So we're not advocating one versus the other. We think everything is needed. We just think investors really need to consider the private side as well. Three main reasons to remember for this. Number one is that private equity offers a greater selection of companies for investors to access. Just as an example, in Brazil, there are around 40,000 mid-sized companies. There's over 200 million companies, but 40,000 just mid-sized companies that are growing and not accessible through the public markets, whereas the Bovespa exchange only has 450 companies listed. So we think looking at private is a way to get access to a diversified number of companies. The vast majority of these companies, and especially the fast growing ones, they get capital from the private markets. The second reason.
Sorry
yes?
to interrupt you, Heidi. If you just scroll down to your slides, we're only seeing the first slide.
Oh, yes, I will come to that.
At the bottom.
Yeah. Yeah.
There you go. Keep moving.
Okay, I'll come there. I'll come there.
All right.
Sorry, so I was just giving the first reason is this broader access. The second reason is the growing industries, and I'll talk about that in terms of the composition between public and private markets. And lastly, the higher returns. So in these next few slides, we'll, now I will move to skip the disclaimer. All right, here we go. So again, why and how emerging markets private equity? So I said higher returns. We have data from Cambridge Associates public market equivalent analysis that they do on a regular basis over a 10-year horizon. I think Neil mentioned this, but over a 10-year horizon, you can see that investing in private markets can offer 700 basis points in better performance than you would if you only invested in the public markets. So investing in private markets can't compensate investors for that lower liquidity that you will find in private versus public. Now, the number of countries to consider when you think emerging markets may be a bit overwhelming. There are over 150 countries in the emerging markets universe. We track 26 of them. Of those, only 10 countries are really our priorities. And these span from Asia to Africa to Latin America. Now, our 10 favorite countries do represent a significant portion of GDP, over a third of global GDP. And we believe that these are the countries that will come out of the pandemic in better shape due to their population size, demographics, and some of the trends that have already been discussed, urbanization and the like. Now, another feature is that private equity adds industry diversification. So diversification being a big theme here. Industry diversification is when you compare the access to the types of sectors that you can get through private equity when compared with the public listed companies. This graph shows that in public markets, in emerging markets, are heavily weighed in the financials and commodities, while the emerging market investments give access to consumer services and technology, which is a huge trend now in emerging markets and globally as a result of the pandemic. I should just point out that a little different from what Neil mentioned is that in our definition of emerging markets, we don't have Taiwan, for example, which in this slide that Neil showed, I noticed that Taiwan had a big chunk in technology. For us, Taiwan is actually a much more developed market, developed economy. But anyway, through the private markets is that we believe you can get access to these smaller companies that are growing very fast and which are not available via the public markets. As far as the industry itself, we spent many years at IFC building the private equity industries. It's still relatively nascent and has a lot of room to grow as an asset class. So you can see here that even the largest markets like China and India, private equity has a very low penetration, well below 1% of GDP. Whilst the US and the UK, which have very developed private equity markets, they're both at over 2% of GDP. Now, we believe that this situation offers two specific benefits. One is that a shortage of capital means that there's less competition for assets, and of course, lower valuations, which we see is the current situation for emerging market assets. And then the second is that as the industry deepens and more capital enters the asset class, and we're seeing this happen also with local investors, local institutional investors investing in their own country's private equity industry, but also more across borders. But as these industries deepen, those investors who came in earlier will have better exit opportunities when the time comes to harvest the portfolios that they have built. Now, drilling down to industries that we like, over the last 10 years, we have focused in these key sectors: healthcare, financial services, communications, information technology, consumer goods, and agribusiness. Our focus has been driven, again, by the demographics, the urbanization, the growth in disposable income, plus a growing global population that is placing high demand on the agribusiness sector. These sectors have shown throughout the pandemic to be pretty resilient, with technology being the big winner. However, we believe that across all of these industries, we're going to see more rapidly adopting technology in one way or another. The whole digitization theme that people talk about. For us, our post-pandemic investment thesis is to continue following these key sectors. We think they have long-term positive dynamics, but we are overlaying the adoption of technology across all companies' operations. And we have seen this increasingly during the pandemic. So just to give a few examples, of the types of investments that we have made. When we invest, we look to build a diversified portfolio, right? And we want to have a lot of companies in there. Again, diversification, risk mitigation. We think for emerging markets in particular, this is a must. But to do this effectively, we partner with local managers who can find those diamonds in the rough and help these companies scale up. You have heard a lot about size, South Africa's, market compared to just one big company in China. Particularly for Africa, the challenge is how do we scale up? But frankly, it's across many of these markets. Now we approach each of our markets differently depending on the dynamics there. 2 examples here, China and Brazil. In China, we knew that a significant opportunity existed in healthcare. So we looked for a really good manager and found a team with one of the longest and most complete track records in that space. And they invest in early stage companies that may be developing new drugs or medical devices, but they're also invest in online pharmaceutical platforms. So this group does a pretty broad range of investments. In Brazil, we wanted to reach to the growing middle-class consumer, and we found a small buyout manager with a reputation for being very disciplined, for buying great companies at great prices. This approach has actually helped us quite a bit to preserve value because, through the pandemic, the real has not done extremely well. But thanks to buying cheap, we have held well throughout the pandemic. And interestingly, for this particular Brazil manager, we have one portfolio company which manufactures alcohol-based cleaning products. And you can imagine how well they have done throughout the pandemic, so much so that they quadrupled business in Brazil, are now exporting to the US, and the company is preparing for an IPO. Now, in total, with these 2 opportunities, we got access to 24 very unique companies, and both managers are top quartile performers. Now, just drilling down a little bit more, we use our network of on-the-ground managers and on-the-ground partners to also source direct investments for our portfolio. Again, to give you a flavor of the types of opportunities that we see, we have invested, well, we have 3 examples here. 2 of them is investments that we have made in a grocery model known as the hard discount retailing. We did that in both China and in Latin America. During the COVID time, both of these benefited from being essential businesses that allowed them to remain open, and also from being located close to the consumer, which facilitated serving their clients during the lockdowns. Now, both companies experienced very rapid growth. They needed capital. They tapped the private markets for that capital. And eventually, both of them have plans to IPO once they are fully established. In terms of scale, just to give you a sense, our Latin America company is based in Colombia. It's regional, and it's at $1 billion in revenues. And the China company is newer. It's actually just in Shanghai. It's at $100 million in revenue. Okay, but they're both growing at a very, very good pace. The third company we invested in that we're featuring here is a software technology platform out of India, which has gone global, providing warranty and device management to the likes of Samsung, Apple, and other name brands. Now, the company it's small, its revenues are $50 million, but it has increased in value 2.5 times in just 2 years. And the company continues to do great. All of these companies are relatively small. When we invested, they have grown significantly, as I have explained, but we wouldn't have had access to them except through the private markets. So just to start wrapping up, we believe that a private equity strategy, as I've described, provides access to fast-growing markets for investors to really unique private companies and to investments that actually have a low correlation to public markets. So it makes a very good complement, we believe, to a portfolio. We have an investment platform which focuses on invest class, environment, social, and governance. There's been already discussion on sustainability. This is very much our theme. It's in our DNA because of our IFC background, but we really look for ways to enhance returns by investing in a sustainable manner. This private equity strategy is available through a listed vehicle that we have set up in Mauritius. I don't know, Fulu, how much you want me to mention that, but we do have a special purpose vehicle set up in Mauritius specifically for South African investors, because this is classified under Reg 28 for South Africa. So, you know, the vehicle currently has over 80 portfolio companies and is raising capital to continue with this strategy. And that is it. Thank you very much again for the opportunity to present.
Great. Thank you so much, Heidi. I think the opportunity set has been presented. Just to clarify on that Regulation 28 matter, indeed, pension funds in South Africa are allowed to allocate up to 40% offshore, with 30% being in global markets, as well as an additional 10% which can go into African markets. And so the vehicle that you referred to could classify as that 10% listed in Mauritius as Africa. So I think both of you have touched pretty much on diversification. There's been several questions that have come through from the rest of the audience. And I would just like to refer back to the poll and thank everybody that has submitted their responses to the poll. If I could encourage more of you to do the same who are still on the line. I see we've still got quite a few people on the line, but I'll just read some of the questions on there, and it talks to the actual allocation. The first one is how much your fund has allocated to the allowable offshore allocation of 40%. And so far we've seen that 38% have said yes, they're at the full maximum, and 62% have said no, they haven't used the full allocation. Just as an asset allocation decision regarding EM as an asset class, and I don't know whether this happened before we started or they were convinced following this, they believe that they would certainly consider emerging markets as an active asset allocation decision. The third question was whether there was preference for listed versus unlisted. So far, 62% of our participants have indicated that they prefer listed markets, whilst 38% indicate unlisted markets. And I think the benefits and the diversification benefits have been shown to indicate that there certainly isn't overlap, and that listed markets exist with their own merits as well as private markets. And so it was never a question to try and determine whether one strategy is better than another, but it was more of a preference and risk appetite. The next question was with regards to the benefits of emerging markets and why people would have included this in their proposition, and the answer was whether it was for diversification purposes or for better returns, and we're pretty much equal on those. There's a perception of the diversification as well as better returns. And following the seminar, do you think emerging markets are best positions to recover quicker from COVID-19? And 76% of our participants have indicated yes. So thank you for those that have participated, and we would appreciate it if you continue to do so for those that haven't. I think just to go back to the question of diversification, and I will pose it to you, Heidi. Is there such a thing as over diversification? Because there comes a point where, you know, if you have too many multiple counters, it may be seen to over diversify. Is there such in one's portfolio?
From a private market perspective, I'm not sure that there's an over diversification challenge. You know, I think that part of the question from the private markets perspective is the size of the opportunities and the cost of accessing those opportunities, right? So, you know, investing in the small business space is very costly. I mean, you can make a $1 million investment or a $10 million investment or a $50 million investment. And if you diversify too much, then if the return for that $1 million investment is not a 50x, then maybe the diversification play didn't really help you. I think from a risk management perspective, I don't see any downside to a very diversified strategy. I think you just need to keep in mind the cost aspect and how that affects the returns.
Great. Thank you, Hadi. We've got a question from Mr. Nolo Letele, who is a board member of NASPERS and also the chairperson of MultiChoice. And his question is on telecommunications penetration per capita being the lowest in the world. It's therefore considered to be the fastest growing. How can we invest in this? So I'll put it to both you as well as Neil, whoever's willing to take that first.
So I'll just address the private. The question was about Africa. I wasn't sure if it was framed in terms of.
Yeah, so it's telecommunications penetration per capita, which is the lowest in the world, right? And it's therefore considered to be the fastest growing. How can we, I guess, as South African investors or as institutional investors, as pension funds in South Africa or Southern Africa, access that opportunity?
Yeah. So, I mean, I think it is really through public and private markets, because there are some of the bigger telecom companies that you all know that are listed and available through various exchanges in Africa and internationally. But there are also quite a number of companies operating in the telecom space, all of which are private. Okay, and these tend to be sold to either private equity houses or strategic investors that are international. And you have to go through a private market. If you have the capacity to go directly and find those companies and do the diligence yourself and monitor and so on, you can go directly to that. Otherwise, you are working with an asset manager that is looking at those types of exposures. So, I mean, I do think it's both opportunities through both.
Yeah, I agree with what Hadi said. Yeah, I was back up what Hadi saying. I agree exactly what she said. In our space, it's quite difficult to get a pure play company, listed company on that specific theme. I mean, you obviously get exposure to the likes of Vodacom or MTN or the such, or similarly listed companies in those different African markets. There's also businesses. There are not many. I mean, there's a business called Jumia Technology, which its tagline is trying to be the Amazon of Africa. I mean, that's a very volatile early stage listed business. But yeah, to answer specifically, it's quite tough in the listed space. I think what Hadi said is quite right. For the private markets, there's also a good opportunity there.
And by the way, these companies tend to scale up quickly. So
great, thank you so much. I think I'm just looking at. Okay, I think technology is failing me. I don't know if you can still hear me. If you can,
yes, we can.
Just wave at me. Yeah, you can. Good stuff. All right. Just from the polling questions, I mean, it seems obvious to me that Southern African institutional investors are seeing value in both private markets as well as listed markets and emerging markets. Do you think there's a reason why there's been a slow take-up in both opportunities?
I can speak from my side. Generally, when we've been marketing over the years in front of South African institutional investors, one of the biggest pushbacks we get is that, well, we are South Africans. A lot of our capital is in South Africa. South Africa is an emerging market, so we don't want to have increased emerging market exposure. Fine, that's a valid point. So a lot of what people do is they allocate to developed markets from a diversification perspective. So they take the 30-40%, and that's where the large chunk of it goes. And I suppose that makes sense to a point. We push back and say, look, that's great, but you've got to be cognizant of where you are in the cycle. And we're not arguing that your full 30% goes into emerging markets. We're saying a portion of that should definitely go in, and the size of that should depend where we are in terms of the cycle. Where we are right now, we're saying that emerging markets in a global perspective are looking very attractive compared to developed markets. And actually, if you look at South Africa, well, South Africa, the correlations, if you look at the market itself, you look at the currency, another thing, the correlations of South Africa versus Asia and other emerging markets is breaking down quite significantly. So, you saw that efficient frontier from a portfolio perspective. It's a great emerging markets for South Africans is a great diversifier in terms of both risk and return. So we think right now it's a great opportunity set.
But I think, in my previous experience as an asset allocator, we've always indicated that asset allocation is obviously determined by the liability profile of the fund. And so COVID and other changes in our environment have certainly shown the cracks and indicated that, one needs to certainly diversify further from just listed markets and start looking at other investment opportunities. I think I indicated right in the start that we addressed investing in private markets. In particular, we also addressed investing in infrastructure. And luckily, Leslie is of the same view around infrastructure and the potential returns that one would get. We can see that from our infrastructure portfolio. It's, the cash flow profile is very little volatility in the profile, as well as positive cash flows and returns going back. Also is to consider what is the right investment opportunity for a pension fund that invests members' money in an area that is not developed. And so there's transformation, I think, in asset allocation, which talks to investing in assets that will improve the lives of the retirees prior to their retirement. And so that's mostly in the private markets and infrastructure, as well as looking for investment prospects that are not correlated to what you already have in your portfolio. And so I think that perhaps answers why previously South African pension fund investors would have said, well, we're an emerging market and we therefore allocate to emerging markets. I think COVID has indicated to us that we need to have a more diversified portfolio in order to outperform inflation, as well as to deal with growth following post-COVID. So I think that answers that question. I see that we've gone way over our time, and I would like to thank both of you, Neil as well as Heidi, for engaging us on the topic and indicating to us what the potential opportunities are in emerging markets, both on the listed side as well as the unlisted side. I would like to thank all our participants who have been patient with us and who have been very engaging throughout the session. We still have many participants on the call, and so we'd like to thank you and being patient with us for going over time. And we would like to remind those that will be receiving the book that it is, we spent only 250 Rand for it, and we will be sending it to you shortly. We will get your details. Thank you so much to Martin and to Leslie, as well as to our chairman, John Oliphant, for engaging in the dialogue right from the start. Yeah, I think it's been a great afternoon, an afternoon well spent. Thank you very much to everyone. Goodbye.
Thank you, everyone.
Thanks, Willie. Thanks, everyone.